Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This will be for Friday, April 7th, getting ready for the open on April 10th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, we have two reports for you today. For those of you advanced options traders that trade condors and butterflies, our market timing report for condors and butters will help you time the entry of these strategies. So many times condor and butterfly traders just simply put on a trade because maybe it was a down day in the market, IV popped up a little bit, or it's because it's a certain Friday of the month or a certain Thursday, so many days to expiration, etc., a seasonal approach. What we do is we take a technical analysis approach and we ask ourselves, is this technical condition a good one for selling premium? And we have ways of measuring this, and I think you're going to be very happy with that. That's good information. Also, we have the directional likelihood report as well. This does a statistical price distribution study of the current market condition in determining where it's likely to go, up, down, wobble around for a bit, etc. Here is the current market condition now. We define it three ways in terms of price action, trend, and the overbought or oversold. Friday was an inside day. Interestingly enough, the previous Friday was also. So 2 straight Fridays of an inside day. Also, we are above the 50-day simple moving average, and our 15-3 stochastic is between 25 and 75, and we are above, just barely above, that 3-day simple moving average, or the percent D. All that makes for a market condition that is fairly rare. It's only occurred maybe 40-45 times since Jan of 2000, moving towards today. All right, so what, 16-17 years, it's only happened 40-45 times. Not that often. So keep that in mind as we move forward with our two reports. The first report. Okay, let's just take a look at the report itself, and then for those of you just new, we will get into the methodology. But for those of you veterans that understand all the methodology, let's just get right to the report itself. Since Jan of 2000, there have been almost 4,500, actually there's been just a little over, 4,500 daily closes of the SPX. All right, now of those 4,500, 64.8% of those have been favorable for selling option premium, where the actual movement was less than the SIBO skew adjusted implied movement of the market. Okay, 64.8% have been favorable that way. Also during that time, this current market condition has occurred, now what we have here, 42 times. 42 times. Of those 42 occurrences, 69% of those bars have been similarly favorable for option premium selling. 69%. Now that means we have an edge of roughly 4.2%. 4.2. So statistically, it's more likely than usual that Friday's bar will end up having been a favorable one for market neutral option premium selling, and that's the results of our report here. Okay, doing that statistical study, we see a 4.2% edge in terms of it being a good time for selling premium in a neutral fashion, given what the implied volatility is, the history of this pattern, etc. Okay, now also we have the more statistically based market likelihood report. This is where we do price distribution bands, and over the last, say, 4,307 closes, from each of those closes moving forward, okay, we have 3 upper distribution bands, 5, 10, and 15 days out, set a standard distribution away. A lower 5, 10, and 15-day standard one standard deviation band, one standard deviation away to the downside. Okay, those bands get hit, as you can see, roughly 23 to 32% of the time. That's the benchmark, so to speak. And then when our current market condition comes around, just 46 times, you'll see that the lower bands, excuse me, the lower bands are getting struck more often of those 46 times in terms of percentage than the benchmark. The upper bands are getting struck less often than the benchmark. So this is a picture of a bearish bias. The lower bands are getting hit more often than the upper bands. This is an obvious bearish bias to this condition. We had it last week as well, by the way, because a very, very similar market condition. And then we have the situation if the market goes above Friday's high. Does that change things? Well, the lower bands still get hit more often than benchmark. And then if the price goes down below the lower, below Friday's low, even then the lower bands get struck more often, and then the upper ones get struck a little bit less often, except for that 10-day band. So a picture of bearishness is what we're seeing here. A picture of bearishness, and we're going to get into the methodology here just a sec. Oh, and then finally, the skew adjusted VIX bands. When we adjust those bands to reflect the market in the options, where the puts are much higher priced than the calls, we're going to adjust the bands for that skew, the market skew. We can see similarly that the lower bands are getting struck more often than the upper bands. Okay, so those are the two reports. I hope that helps those of you familiar with this methodology. Let's move on to the methodologies itself. This is the same presentation we do every week, just to bring the new folks up to speed. Okay, so before we do that, I want you to take a look at the link here to get our free e-book called Simple Steps to Options Trading Success. Also, we would appreciate it if you would subscribe. That way, when we come out with a new post, that you can instantly get a little reminder there, a notification letting you know that we have a new recording available for you to watch. Okay, let's look at the timing report and why we do this. Why do we look at the timing report? Why can't we just use seasonals? All right, so let's just take an example. Here's an example of the market channeling around, and Condor butterfly trader might say, you know, now's a good time to get into this because the market's chopping around. Well, if you'd have taken this exact market condition, gone in the past and seen if it was a good time to sell premium or not, you would have discovered a negative edge. Negative 4.2% edge. That meant that at the time there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. A negative edge. In this case, it turned out to have been predictive, because the market did indeed go crazy, especially on the downside there. Okay, so this is something that has validity. We do look at it, and it can really be predictive at times. And so here's our current market condition. The question on the table is this current condition a good one for trading condors and butters, for selling premium through range trading? And here's how we do this. Here's how we answer that question. We first observe how much the market actually moves from a given close. We call that actual volatility. We then observe the market move, what market move is predicted by option prices. That's implied volatility. Then in hindsight, we compare the two, and we label bars in hindsight having been either favorable or unfavorable for selling premium at that time through range trading, butters or condors. So let's just take a look at an example of our methodology here. We could take any close, go forward 21 bars, and ask yourself, how far did the market move? What was the farthest it moved, up or down? In this case, it moved down the farthest. Certainly didn't move up that much. It moved down 50 points, which turned out to have been 2.4% of the value of the index, the S&Ps. At the time, though, we can graph that in an indicator there. What market move, though, was being implied by the option prices? So we know how far the market moved, but at the time, what were the option prices saying? And when you go to the VIX, adjusted for skew, The 21-day VIX move being implied was a 4.4% move. That's higher than the 21-day actual move. So in hindsight, we would label that bar as having been favorable for selling premium neutrally. We would paint the bar blue, and we're going to paint all the bars blue that similarly turned out to have been favorable. We're going to paint all the bars red, where we had the market move higher than what was being implied by the option prices. Blue bars and red bars. We divide up the market that way for doing this study. Now, what do we do now? We're going to look at historically what percentage of the bars are blue. Going all the way back, 4,300 bars, what percentage of those were blue? And then, that's our benchmark. Then, of the bars that match our current condition, what percentage of those were favorable for selling premium? There might be an edge here if there's much of a difference. So when we go back and look at how many at the 4,300 bars from Jan 2000 moving forward, we discover that 64.8% of all the bars turned out to have been favorable for selling premium through Butters and Condors. Okay, 35.2% turned out to have been a rough ride. And the rough rides are why we need good adjustments, a good adjustment strategy. And here at Discover Options, we are very good at giving you strategies for adjusting your butterflies and your condors. So give us a look if you're in the market for approaches on how to do that. Now, of the bars that match our current condition then, what percentage of those were historically favorable for selling premium? So here we have, look at this, turned out to have been 5 in the recent history. That's a lot. That's a lot that match our current market condition. There's been only, 40 going all the way back, 40, 42 going back to Jan of 2000. You have 5 bunched up like this. Very interesting. Okay, so of the bars that match our current condition, what percentage were favorable? 69% of those 42 bars turned out to have been favorable for selling premium neutrally. When you crunch the numbers, oh, that's wrong. It should be 4.2%. How did I do? Oh, I got rid of the wrong slide. Look at that. 4.2, 69.0 minus 4.8 is 4.2. 4.2 edge. That means there's a higher than usual likelihood that the market will be less volatile than what is implied by the option prices. So that is how we come up with our methodology here to do this. And we do this every week, and glad you could join us this time. Before we get to the likelihood report, reminding you we have a fantastic curriculum here at Discover Options to take you from an intermediate beginning level up to an advanced level in as quick a manner as possible. So check out our curriculum here. You could go to discoveroptions.com, give us a call, ask us any question about our curriculum, and we can design a custom one for you as well. So give that a consideration, please. Let's go look at the likelihood report. The question here is, since Jan of 2000, how often has this same market condition occurred, and what did the market do in terms of direction and volatility? Okay, now here's the thing. If you have a good setup, let's say a breakout from a trading range, some pattern that people look to as being a favorable one, a good technical breakout, okay? If you could take that same technical condition and go back in time and look at how many times it did it in the past, wouldn't you think that that the distribution of prices after those breakouts should generally be bullish? In the case of a bullish breakout, if you went back in time, the distribution of prices would be skewed upward. Or maybe a certain pattern, maybe a pin bar with a breakout after it. You know, maybe going the other way, going bearish. If you had a bearish pin bar with a breakout to the downside, well, wouldn't you think that if you went back and looked at that pattern, the numerous times in the past that we would discover that historically price was distributed a little bit bearish. Well, how can we measure that distribution? What we want to do is take our current market condition, go back in time, and just see how price was distributed. Bullish, bearish, wobbled around in the middle, didn't do much. So here's what we do. We want to understand the historical distribution of price, just a random benchmark. We understand then the price distribution after our condition develops. We compare the two and we discover there might be an edge. So let's do this. How do we determine price distribution? We measure by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. Okay, I use 3 sets, upper and lower 5, 10, and 15-day bands. These are set 1 standard deviation from the close. I use a 20-day historical volatility level to determine the width of those bands. These will look normally distributed. So here's an example. Here's an example here. We have an upper band and a lower 10-day band. Over the next 10 days, does price go up and hit the upper band, the lower band, or stay in the middle and don't hit either? Okay, and so in this particular case, we discover that for that close, price hit the upper band, and that is what we record in our database, our distribution database for that particular close. Now, we come to this close here on the far right. We have an upper 10-day band, a lower 10-day 1 standard deviation band. The question here is, does price hit the upper band, the lower band, or stay in the middle and not hit either? What happened here is that price tried to hit the lower band, it failed to. So for that particular close, we record that the market hit neither of the bands. And so then we basically, for every close, we record whether price struck the upper or the lower 5, 10, or 15-day bands. And we keep statistics on this. And we discover that through April 7th, starting in Jan of 2000, price struck the upper 5-day band 29.6% of the time. So 29.6% of the closes involve price going up and hitting that 5-day 1 standard deviation band to the upside. The upper 10-day band was hit 23.3, 15-day band 23.2. The lower bands were struck 29.4, 29.1, and 0.332. Okay? Now, okay, good. I think we're going. All right, good. So that is the statistical distribution on a random basis. Now we're going to understand the distribution after our specific market condition develops. So we look at our market condition. Now look at this. We're going to take a look at distribution as of the close. We're going to look at distribution in the case when price goes above Friday's high, the previous day's high. In this case, it's going to be a breakout of the previous days after an inside bar there. Or if price goes below the low of Friday in this case. What's the distribution in any of these cases? I think it'll help us on Monday understand the possible distribution and the statistics no matter which way the market goes. So as of the close on Friday, we had 46 occurrences. Look at this, the upper 5, 10, and 15-day bands were struck 17, 19, 17% of the time compared to much higher numbers on our benchmark. So these upper bands were struck much lower, 12% lower, almost 4% lower, almost 6% lower. The lower bands then got struck more often. Look at this, the lower 5-day band was struck almost 48% of the time compared to just 29.4% of the time benchmark. So these lower bands of these 46 occurrences, these lower bands are struck significantly more often than benchmark. This is a bearish picture here. If price goes above Friday's high, the previous day's high, that's happened 21 times in the past. Still, the lower bands get struck more often. The upper bands get struck less often in 2 out of 3 occurrences, in 2 out of those 3 bands. If price goes below the low of Friday, okay, let's set this back. Oh, set to back. There we go. Still, the lower bands get struck more often. 2 of the 3 upper bands are struck less often. Up again, folks, a picture of bearishness. Now, what we like to do is sometimes look at these bands, having a different volatility input go in there. And it would be using a skew adjusted VIX. VIX is generally higher than statistical volatility, so the bands are going to be wider than the other bands, and they will get struck less often in their benchmark like you see here. Still though, you can see that the lower bands are getting struck more often in 8 out of the 9 times than the benchmark. And the upper bands are getting struck less often in all 9 of those circumstances that we observed. So again, a picture of bearishness. Does it mean the market's going to go down? No, of course not. It means that there is a likelihood, a greater than normal likelihood, that the current market condition we're in is going to result in bearish behavior. That's all we could say. Okay, the upper bands can still get hit. They have been hit. Look at this, 13, 14% of the time, going up to 20% of the time. So they can still get hit. It's just that in terms of statistics and historical observation, we would conclude that there is a greater likelihood for some bearishness after the condition that's developed. Folks, thanks for joining us. I'm Steve Lentz with Discover Options, the trusted and proven options education firm for your options education needs. Thanks so much. We'll be back next week. Have a great week. Bye-bye.